Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. We've heard about the Trump accounts. We have some questions about what are the Trump accounts for? Are they only for newborns? And when is it going to be effective? They said it's effective January 1st, 2025, but how can we open one? How are we going to record this on our tax returns? A lot of questions are raised about around this topic, and while we still don't have all the answers, we have some, and I'll try to break it down for you as I always try to make things simple. So I'll try to break it down for you so that you have some answers, and definitely happy to answer any specific questions you have should you need more clarification. All right, so let me start and I'll share my screen. And the joke today is related to the Halloween. I know that sometimes nothing is scarier than taxes. And yeah, a tax bill coming your way, you get so scared. So yeah, happy Halloween. All right, so what are we talking about? The Trump account, this is a new tax smart saving tool under the OBBBA or the One Big Beautiful Bill Act that was enacted into law on July 4th of 2025. So what is a Trump account? As we know that the One Big Beautiful Bill Act signed July 4th, 2025 introduced the Trump account, which is a new saving vehicle for children and families of children, of course. It applies to children under 18 and newly borns, like newborns between 2025 till December 31st, 2028, are automatically seated with $1,000 federal contribution. That's in addition to child tax credit that has nothing to do with anything. They're automatically seated with this $1,000 as a federal contribution that's a tax-free to the child, to the family, just a gift from the government for your newly born. And the idea is to promote the long-term wealth accumulation and financial literacy to help the child when they're 18 with their education, with their starting their career, whatever it is at the time. All right, so what is it? What's a Trump account? Again, it's a tax advantage account for children under age 18. They have to be with a social security number to be eligible for it. There is an annual contribution that's not from the government. This is annual contribution from you as a dad or as a mom. Like as a parent, you can contribute to the child account up to $5,000 per child. And it's after tax dollars. So you're not getting any tax deductibility on this $5,000. The investment side, the funds have to be invested in a mutual fund or traded fund that mirrors the S&P 500 or another US stock index. So it's a very restricted in where the investment could be. There is an employer contribution. So as an employer, you can make this as a benefit to your employees and you can contribute up to $2,500 per year tax-free to the employee while you as an employer take the deduction. So it's also another benefit that can work as like an employee retention benefit. As we said, the US index fund, and it converts to traditional IRA at age 18. So at age 18, you would consider it as a traditional IRA. Any distributions would be you would pay taxes on it. Okay. So contributions, as we said, it's after tax for parents, tax-free for employer portion. That's up to 2,500. The 2,500, by the way, it goes toward the 5,000. So it's not 5,000 in addition to 25. No, it's all in all 5,000. Employer can contribute up to 2,500 for your employee, tax-free for the employee. If they contribute 3,000, then 2,500 tax-free, 500 would go into your taxable wages. The contribution grow tax deferred, so it grow tax free. You don't pay anything until the distribution. Withdrawals are restricted before age 18. You can't really touch it. And when you're 18, you can roll it over to an IRA, which ensures like you're getting compounded interest or compounded return on investment. Okay, so parent contribution after tax, no deduction. Have to stress on this. You're not getting any deduction on the $5,000 that you're putting to your to your child. It's just instead of you putting into a regular say a regular saving account or checking account, you're putting it into this Trump account to grow tax free, and you know where you're gonna invest it. The employer contribution part is free to the employee toward the limit, and the federal seed is a $1,000 tax-free only for children born between 2025 and 2028. So why it matters? First of all, it's a very good opportunity for early wealth building for children. It creates an opportunity for family employment. So if you hire your child, you can definitely make use of the employer-employee portion even without hiring your child. If you yourself or your wife is an employee of the business, you can make use of this plan, but you have to consider whether you have other employees that you want to make the same thing for them, because it like you have to consider like the plan administration. Same thing as if you're offering any other benefit like a 401k, for example. So we still have to figure out the plan administration part. If you have non-family employees, we'd have to give them the same benefit. Um, but it could be a saving opportunity for those for solo employee of their business, so that they can make use of the tax-free portion of the income while the business takes the deductibility. All right. And as a regular employer, even if you have other employees, it's just a retention benefit for your employees with children. It complements the overall family tax plan, as as we're gonna see in the next slides. It goes along with other things. It doesn't just go alone by itself. Like we don't just consider it as a standalone strategy for children wealth building, but along with other strategies. All right. So that's one thing. Like, how would that compare to a 529 plan? And the goal from a Trump account is really long-term investment, maybe retirement, but it's like it doesn't have to be you don't have to wait till retirement. But the 529 plan, it's mainly for education. So 529 is very stricted in what you can use it for. The Trump account, you can use it for other things. The tax treatment here, this is tax deferred, because you're going to pay taxes on anything that you withdraw. This is tax free if you use it for education. Withdrawal here is limited before age 18. This one is flexible for qualified expenses. You can be 18, but you have college expenses. You can use it actually, even if not college, as with the other, you can use it for other like elementary, middle school expenses. Employer contribution, it's allowed under the Trump account. It's not allowed under the 529 plan. The investment control, here you're very restricted with what you can do. The 529, you have broad options, but again, 529 remains ideal for education, especially with the limits, because here you can contribute up to a very higher amount than what you're allowed to use under the Trump account. The Trump account, you're really limited to the 5K, but 529, you can contribute way more than that. And it's not, it's like even with the gift tax, it provides better and way higher flexibility. All right, so what about the Roth IRA? Is there a difference? Again, Roth IRA, to create it for a child, the child must have earned income. So unless the child is like hired by your company or has its own, like with some high schoolers, for example, they have some work, so you can create a Roth IRA for them if they're working, if they have earned income. But if not, then you can create one for them. But with Trump account, you definitely can from year one. The Trump provides the parent employer funded. The Roth IRA doesn't have that. They're both long-term growth, and Trump adds the employer portion. With UTMA or UGMA, they're both flexible, but they're subject to the kiddie tax. So you have to pay taxes not on the child level, but on the parent's level if it exceeds 2,500. So it's taxable. It's not tax-free. It's not tax-deferred either. Its Trump account is restricted investment options, but tax deferred. UTMA is flexible. It's not as restricted, but Trump, you can look at it as its disciplined growth. Okay, so planning opportunities, you really need to combine both, like 529 plan along with the Trump account. 529 plan also provides some state deductibility. So it depends on where you are in the state. Some states provide deductibility for the contribution that you give them. Trump account again is after tax. You can also pair it with a Roth IRA if the child has earned income for tax diversification. And you need to really include it in your gift status strategy because it counts toward the annual gift exclusion. And as we mentioned, there is an employer contribution as a benefit. Case study, I'll show you with the numbers, like how with if you contribute like 5K per child yearly at 7% growth, how this would grow like to 200K by age 18, and then you roll it over to IRA and you have wide range of use for it. The key takeaways that it complements your 529 Roth UTMA. It's not really a replacement because each one of them is unique in what it provides, whether it's the purpose for retirement or education or other purposes, whether it's the tax treatment of each one of them is different. So you really need to complement it along with what you already have for your child. You explore the employer contribution portion, especially if you're self-employed. It may mean tax saving for you. And you need to really identify the eligible children. Who do you have that can benefit from this? Again, as we said, if you have if the child is under 18, if they have social security number, you need to start considering this. And by the way, for the like the contribution from the IRS, so they will start this in July 4th, 2026. And if you file your tax return and have an account for your newly born child, you will find the IRS opening one for you. But you don't want that mess to happen because you never know how it's going to work with the automatic kind of thing. So you need to be proactive and you need to open it before they actually open it for you. I think it just because again, you never know how this is going to work and or how it's going to affect you accessing the account, knowing what's going on and all of that. So this is just a heads up for any person expecting a child or already has a newly born in 2025. So you need to ask yourself, how can the Trump account fit into my financial or employee benefit strategy? What's your priority, education or retirement? Maybe combination of both. Definitely early planning means bigger compounding. As early as you start, it starts to compound for your child, and it prepare your family or employees to benefit from the new O3B saving tools. There is definitely the $1,000 at least is again a gift from the government regardless. So you need to make use of this even if you're not going to contribute anything more to it, even if you're not going to do anything else after that. So again, if you have more questions about this, I would encourage you to join me for a free 30-minute consultation, talk about the Trump account, how can you contribute, incorporate this into your tax plan for your children, and whether your children qualify, how can you benefit from it in your medical practice, for your employees, for yourself, for your family. Happy to provide more insights into that. And I'll stop sharing this one and I'll share my other screen just to show you a very simple, um, like calculation tool, just to show you the compounding thing. So here, yeah, so let's say this is 18 years. The rate of return, let's assume it's 7%, and the initial investment is $1,000. Additional investment is the $5,000. And this is compounded interest every year. The expected inflation rate, let's say 3%. You see, this is how it may grow over the years. So it's this $1,000 over 18 years with the $5,000 additional investment, it can total to be 185K after 18 years. When your child is 18 and he has into his Trump account 185K, that's a nice gift that he would really appreciate. So this is something just to play along with and see if I just wanted to show you this as like a visual look to see how this gonna affect you. All right, so again, happy to answer any questions you have. I'll stop sharing here and I'll see you next week. Bye.